Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
A very good question is there a way to quantify this momentum? There are some people that will use momentum oscillators for helping identify the momentum, but I find that what works best is just eyeballing it. So what I'm doing is basically I'm looking at the previous moves that took place before this. So even though we have a really limited amount of time here, I mean we're only looking at from July to January of this past year. When I'm looking at the average momentum moves, I'm going back to a larger time frame, or I'm looking at more data on this daily time frame. So I'm looking at, what were average momentum moves back in the past on this security? And I use those to judge what the current action is, because this might look like extremely sharp, for instance, on this daily time frame in September. But if I went and compared it or squished my charts up or, elongated my charts, it might look completely different. So you have to look at it not just in the context of the immediate action, but just look and compare how the previous moves took place, And is this a stronger than average move compared to most of the previous upside moves? What you'll see is that, yes, this was definitely sharper than average. So I do just like to eyeball things. I don't like to use a lot of indicators on my charts at all. And what you'll find is that a lot of the professional traders I know that have been trading at least 10 years or more, most of them don't rely heavily on indicators. I like indicators to begin with because I think they help provide people with additional visual cues. But as you start to trade more often, you're going to be able to develop more of an idea of where those levels are going to be without needing to add things onto your charts. And what tends to happen a lot of times with indicators is that they can provide conflicting cues, conflicting information. So particularly moving averages, for instance. Moving averages are great if you're in a trend, but if you fall into a congestion or something, they're not as good. Even just look at this, for instance. The moving average on here is a 50-period simple moving average. Works great when we're in a trend. You can see that as it pulled into it, each time it held it at least, somewhat. Once that trend breaks and it starts to pull into more of a congestion, notice there wasn't even any reaction to it whatsoever as it fell sideways. So this is a little bit of an extreme because sometimes there will be a little bit to start with and then it'll just be less important as the range progresses. But, that's just one example. And if you're scared taking a long position because it's right at a moving average, well, you're probably going to miss a position that could end up being a really good one. So I like to avoid indicators whenever possible, but I will use the very few indicators I use are moving averages and Fibonacci, and that's pretty much about it. I can't think of the last time I used anything else, actually. I use simple moving averages. I know some people use exponential, and I think it doesn't really matter. Once you start to use them, you're going to be able to get a feel for them. So if you're newer to trading, just play around with the exponential or smooth moving averages compared to a simple moving average. The difference is just that an exponential moving average puts more weight on the more current data, so sometimes it can help adjust to when trend moves begin to shift more quickly. Let's move on to the next thing that we look at, because I want to make sure we have enough time to look at the most current data and what our expectations are for that. The next thing that I look at are the support and resistance levels. And these are just price zones in the market where a security is liable to react in some manner that affects the trend that is in play as the support or resistance levels hit. There's a number of different types of support and resistance. Some of the basic ones, and these are just a couple of them here, are whole numbers. So if you trade like securities or options or things like that, you're going to have a whole number of support and resistance levels. Things like previous highs, previous lows, prior congestion zones, as well as equal or measured moves. Most of you are very familiar with the concept of, well, a previous high, when it retests it, is going to be a resistance zone. But notice that there was one key word in that sentence, and that was the word zone. When you're looking at support and resistance levels, a lot of times you can put an exact number to that support or resistance. For instance, a moving average is going to be an exact number. A previous high, previous low is an exact number. But you don't want to think of them in terms of exact numbers. You want to think of them in terms of price zones. So this previous high here, it has a resistance zone that is closer to that. And when you have V bottoms like this one or a V top like these, usually it can stall before it hits that exact previous high. If you have a previous high, usually there will be a little bit of congestion like we saw with the dollar index. Pulls back. It'll come back up, but that zone serves as resistance, and it might not necessarily hit that exact high. If there's any slowing momentum into that zone, that also can help give you an idea of, well, how well is it going to test it, or how well is it going to hold it or not. If it just rallies really sharply into it, or gains momentum, builds momentum heading into it, maybe it starts off slowly coming off of a low, and then builds momentum, starts to pick up, becomes stronger into a previous high, then it can push the upper limits of that previous high better and even have a higher chance of breaking it. So think of these previous highs and previous lows as these congestion or resistance zones. Like I mentioned, a lot of times you'll have a little bit of congestion, and congestion levels are another really great place to identify support and resistance. This is one of the major tools that I help use to identify target levels. We saw that on the dollar index. Let me actually back up to that fast. Our target on the dollar index was based upon this zone here. Basically, congestion or slowdown in momentum started at the beginning of August, and it broke out here going into October. So I used the middle of that pullback or that correction as my target level for the dollar index. We look at the euro, and what you can see is that the low, and the reason I expected it to hold that zone in November, was it was the middle of that congestion from back in 2006. So this gave us a really high probability that we would see that zone hold and see some sort of reaction off of that level. For those of you that, let me just show you, let's see here. I was going to try to pull up a chart that showed the option, but it's not loading very quickly. I'll try it again a little bit later if we have time. Like I said, you can look at the charts for the options at ise.com/quotes. What you can see here even is that notice the bounce on the euro. When it bounced in November, what happened? It came right into the resistance from not only this little zone right in here, but also the zone from the end of 2007 and the beginning of 2008. So when you have a V bottom, it's very easy to help identify where these target levels are going to be, where you expect to see some sort of reaction or resistance. And that's going to help you identify, how much room do I have in this security before it might stall? This could have stalled a little bit here from 2007. But the momentum was really sharp coming off of that low, so it helped push through that initial resistance zone and come into a higher resistance level because of the stronger momentum.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.